I did not do a video last week because I was traveling. It was just too complicated to do the video on the road. So this is from 2 weeks ago to today, covering a span of a couple of weeks. I'm going to cover the economy and the stock market for the rest of 2023 and bring in some expert interviews and what they're saying about what's coming. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 16, 2023. I'm going to begin with an interview that Morgan Brennan at CNBC did with Bob Dahl and Mimi Duff. It kind of resonated with me a little bit because about 10 years ago, when I was in Seattle, I had the privilege of listening to Bob Dahl and got a feel for who he is. And he's a strategist on Wall Street and has had a distinguished career. And because I met him and have a feel for him, I respect what he has to say. So this is an interview that brings him into the picture along with Mimi Duff. He talks about the earnings being that are probably going to be lower. They were higher than expected for the first quarter for, let's say, the S&P 500. And they are expected to be, he believes, lower for both the second quarter and or the third quarter of this year. And as a result, he expects that stocks will decline as well. Putting a time frame on this is difficult because you can say, okay, earnings probably going to be down, but which ones and how the market responds and when, very difficult to do. But I would say in general, I agree with his comments. Mimi Duff adds to her comments to it, and she said she expects a milder recession in 2023, and same as Bob Dahl, she expects the stock market to come down as well. She goes on to say that we still have high inflation and that there are more Fed rate cuts to come, more raising of rates by the Fed to come, no rate cuts and maybe a pause. But the market has gotten ahead of this. And so they're trying to bake in to the expectation that there are going to be cuts and there's going to be a pause. And I think you'll see through these interviews that people are saying that's too aggressive. And as such, stocks have gotten back to a place where they're probably overvalued. So take a listen to Morgan Brennan interviewing Bob Dahl and Mimi Duff.
Joining us now is Bob Dahl, CIO of Crossmark Global Investments, and Mimi Duff, Senior Client Advisor at Gen Trust. Good afternoon to you both. Bob, I'll start with you. It's so many cross currents in terms of the push-pull in this market between bulls and bears. What's priced in here, and is it warranted?
Great observation. The market's always uncertain, but it seems more uncertain than usual. Look at the Fed. Are they going to raise rates next? Are they going to lower rates next? There are differences of opinion there. My view is what is not priced in is a recession that we might get and earnings estimates coming somewhat lower. The market is also pricing in, as you know, a Fed pause as well as some cuts later in the year. The pause makes sense to me. I don't think inflation's come down enough for them to turn around and say, oh, we were only kidding, let's start lowering rates. So what's not in the market tends to be, in my view, more negative observations.
Yeah, and of course, we did get some hawkish remarks just earlier this morning from the Fed's Bowman along those lines, too. Mimi, it was a 1-2 punch from the University of Michigan Consumer Sentiment Survey today. You had a sharp drop in sentiment, and then you had a rise in long-term inflation expectations. That really pushed the reversal that we saw in stocks here today. Hard landing, soft landing, or still too soon to tell?
Well, I do think it's probably too soon to tell. Like, for the most part, we believe in Bob's thesis that stocks are probably priced a little bit too well toward a soft landing. We're expecting more of a mild recession as our baseline. And we do expect inflation to be a bit stickier. We don't see cuts in the forecast. So in particular, one of our views is that it will take a little longer for inflation to come down. And 1 and 2 year TIPS break-evens are priced for perfection. The break-evens are just south of 2%. And we don't think that inflation is going to get to that target in the next 1 to 2 years.
Next, I'm going to play a piece by Bloomberg's David Weston interviewing market strategist Ed Hyman. And he is well respected, has been on Wall Street for a long, distinguished career. And he will talk about the forecast for a recession he believes probably in the third quarter. And he gives 3 reasons why that is.
Time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And David, you sit down with a lot of interesting folks, but you actually had a chance to sit down with really one of the legends in economics and really independent research out on Wall Street, Ed Hyman, a little bit earlier.
Yeah, and you said it, Romaine, and we had those strong numbers out on Friday, and yet they're still projecting a recession. So we sat down with Ed Hyman. He is the vice chair of Evercore and the chair and founder of Evercore ISI. And we asked him why he still thought we were going to have a recession, at least by Q3, despite those numbers.
So this is the toughest time I've had. I've never forecast a recession this far in advance. So this could be the end of my career. But early on, I became a follower of Milton Friedman and the money supply. And the money supply is now contracting, and it's associated with the banking crisis. Bank deposits come down. And then somewhere along the line, I picked up the yield curve. And as you know, it's significantly inverted. And then, just as a follower of the policy, you have QT as the third item. There's no history on that really discussing it or analyzing it. But then I've also found that if we're tightening and other central banks aren't tightening, it's not so bad. But if we're tightening and other central banks are tightening, it makes our tightening much more aggressive on the economy. So obviously you have all those at work, and they take about 1.5 years to impact. If you can believe this, John Maynard Keynes wrote a paper in 1923 saying it took 16 months. So the economy right now is very strong. It's amazing. But I'm patient, and I think that by the summer, we'll start to see a recession unfold.
I don't normally play pieces from members of the Federal Reserve Board or the Federal Reserve presidents of the regional offices, but I'm going to play one. I have the opportunity to hear this by the Atlanta Fed President, Rafael Bostic, and he is being interviewed by CNBC's Steve Leisman. And so he gives some insight not into the Federal Reserve in its entirety, but into Rafael Bostic's view from within the Fed. And he says, again, these are all echoing kind of the same thing. Inflation is still high. It's still relatively high. It has come down some, but the delayed effect of the hikes that have occurred is still occurring, and he expects more rate hikes in order for them to hit their objective of 2% or thereabouts. But again, the market is too optimistic and has gotten ahead of that, and so I would expect, you can read into all of this, I expect that the market will pull back. I don't think it'll crash, but I think there will be a pullback of, I'd say at least 10%, and it could even be as high as 10 to 20, but not a major crash. So take a listen to Rafael Bostic and Steve Leisman.
I'm here with Atlanta Fed President Rafael Bostic, our host for today and for the conference here. Rafael, let me just start off with, I think we know where you are on rates. What do you think about where the market is? When you look at where the market is priced for the year end, it's a 440, 439, what you call it, January Fed funds contract, which tells you what they think for the full year. That's 75 basis point difference. Is that worrisome now? What explains it? There's something you've done about it.
Well, first of all, good morning. It's good to have you here, Steve. Always good to have you at our conference. I've been really wondering about this for a long time because, in my world, inflation is not going to come down very quickly. And in that regard, then cutting rates doesn't really fit into that scenario. So, the markets, I think, have been pretty optimistic about how easily inflation will respond to our policy. Honestly, I hope I'm wrong and they're right, because that'll mean that the economy is in balance sooner than later. But it's not my baseline case at all.
What accounts for the disconnect, do you think?
That's a good question. I try not to speak for the markets. What I would say is, even in my building, there is a lot of debate about how strongly our policy is going to bite on the economy. Some think it's actually going to bite really, really strong and come down fairly rapidly. But our fairly rapidly is not even as rapid as the markets are. So my baseline case is we won't really be thinking about cutting till well into 2024. I think what we're going to see is just an orderly decline. I'm hoping that we see what we've seen over the last several months, where inflation has come from a very high level to now it's just a high level. But even if you look at most measures of inflation, they're still 2 times where our target is. And so there's a long distance still to go.
Over the past 5 or 6 months, I've played pieces from Mike Wilson from Morgan Stanley. He has been, he says, based on Morgan Stanley's view of the assessment of earnings and outlook, that he believed that the earnings for the first quarter and the forward guidance from the first quarter would bring the market down probably sometime in the early second quarter. That has not happened. It didn't happen because the earnings were better than expected. However, what's occurring is that during the second quarter and perhaps the third quarter, as you've heard from these other interviews, the expected earnings are going to be coming down. They're too lofty. And so there's a delayed effect from what Mike Wilson said was likely to occur. But each week he does a podcast. And so this is an audio podcast. I thought I would play a couple of 2 or 3 minutes of it. It gives his view, and this is from last week, but it gives his view of sort of what's happening, what they believe, Morgan Stanley believes is happening in the second and third quarters of this year. And he states the 3 reasons why he believes that we will have a slowing economy and a declining stock market. One is earnings, which he's very focused on. The Fed will continue to raise rates, and the consumer is already slowing down the purchases of discretionary goods. Consumer staples will continue to be consistent, but as you would expect. But the discretionary items and the ETF XLY for the discretionary sector of the economy is very elevated, and that is likely to be to come down. So take a listen to this podcast from Mike Wilson from last week.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, May 8th at 11 a.m. in New York. So let's get after it. In this week's podcast, I will discuss 3 major topics on investors' minds. First quarter earnings results, the Fed's decision to raise rates last week, and how the consumer is holding up in the face of a debt ceiling debate with no easy solutions. First on earnings, the first quarter earnings per share beat consensus expectations by 6 to 7%. Furthermore, second quarter guidance has held up better than we expected coming into the quarter. That said, it's important to provide some context. First quarter estimates came down 16% over the past year, double the 20-year average decline over equivalent periods, and a more manageable hurdle for companies to clear. Furthermore, the macro data improved in January and February as seasonal adjustments and easy comparisons with the early 2022 breakout of Omicron flattered the growth rate. Nevertheless, this improvement also helped earnings results on a year-over-year basis and provided a boost to company confidence about where we are in the cycle. Unfortunately, many of the leading macro data we track have fallen and are not pointing to a similar reacceleration in earnings per share growth that the consensus expects. Ironically, this comes as many companies position 2023 growth recoveries as being contingent on a solid macro backdrop. If one is to believe our leading indicators that point to downward trends in earnings per share surprise and margins over the coming months, stocks will likely follow that negative path lower. With regard to the Fed, Chair Powell pushed back on the likelihood of interest rate cuts that are now priced into bond markets. While bonds and stocks faded after these comments, they closed the week on a strong note. We believe the equity market continues to expect the best of both worlds, interest rate cuts and durable growth. We view the likelihood of reacceleration in growth in conjunction with interest rate cuts as very low. Instead, we believe another chapter of our fire and ice narrative is possible. In other words, a tighter Fed even as growth slows towards recession. This would be a difficult environment for stocks. So what are consumers telling us? Today, we published our latest AlphaWise consumer survey. Consumers continue to expect a pullback in spending for most categories over the next 6 months. Consumers still plan to spend more on essentials like groceries and household supplies. However, they are looking to pull back on discretionary goods spending. Categories with the most negative net spending intentions are consumer electronics, leisure activities, home appliances, and food away from home. Grocery is the only category where low and middle income consumers said they are planning to spend incrementally more over the next 6 months. They are not planning to spend more on any services categories. For high-income consumers, travel is the only services category where spending intentions are positive, and grocery is the only goods category where spending intentions are positive. Interestingly, the high-income group indicated negative spending intentions for food away from home and leisure services. Bottom line, the consumer looks to finally be pulling back from an incredible 2-year run of spending that was always unsustainable in our view. Some of this may be due to inflation and dwindling savings, but also the very public debate around the debt ceiling, which does not appear to have any easy solution. This is just another wildcard risk for stocks as we head into the summer.
Okay, now I'm going to shift gears to the flow of funds report. No surprise, the last couple of weeks, the market has, generally speaking, been coming down a little bit. Not a lot, but so conventional equity funds have had an outflow of funds of 11.8 billion. Bond funds, a little more flight to safety, an inflow of 1.7 billion, and money market funds, an inflow of 18.3 billion. So that kind of reflects the mood that was pervaded the market in the past couple of weeks. Congress and the president are working on resolving the debt ceiling. It's political. I don't get into political items, only as they affect the market, but I am cautious, and I'm kind of a common sense person, so when I think of politics, and so this thing of the idea of spending money, just continuing to spend way beyond our means, way beyond our revenue, going further and further and further into debt. And an additional item that's pushing it higher is the interest rates, because interest rates for everyone is up, and the government pays their share of the higher interest rates as well. So higher interest rates on higher amounts of money. So it just doesn't make sense to me that we should be spending money we don't have. Building a deficit, not just in absolute terms, but in relative terms, relative to the gross domestic product, the economic output of our country, is also going higher. It just doesn't make sense. It seems that we should be able to live within our means, and hopefully they will work this out. I actually believe they will work it out. So the market is kind of factoring that into market prices at this point. But I would think there would be just some common sense things they could do. You know, the thing nobody's talking about the waste in government. When Senator Tom Coburn was in office, he's retired now. When he was in office, he kind of made it a project to dig all of the waste in the government. And I don't remember the number. It was tens of billions, maybe it was in the hundreds of billions, I don't remember. but it was a very high number of just pure waste, every department. So I think the government's bloated. I think there's way more people than they need. I think if they just focused on the waste and let people retire and don't replace them for a while, that alone would do a lot. But I think they're going to negotiate this and work it out. That's just my opinion. But I saw this and I thought of this, someday, son, all of this will be yours. And what a sad picture that is for us. But thank you for watching. And if you have questions or comments, leave them in the comment section below. Thank you.